Bonjour, c'est un grand plaisir d'être ici avec vous. Doublement parce que nous sommes à Goldman Sachs, la maison qui m'a construit professionnellement. So, it's a great joy to be here with David. We were partners together here, and I had the privilege to work with him on some IPOs in my time. And the way we thought about this session is we want to give you a front row seat to the dialogue that we would have with each other on these matters. And so less of a Q&A and more of us talking about the things that are most on our mind about the topics that Paul had mentioned. So I'll start us off. You have the huge privilege, both individually and as Goldman, of seeing a very significant percentage of all the IPOs that happen in the market. If you think about 2022 and 2023, what are the big changes that you have observed in your career? And what of those changes do you think are here to stay?
Great. Well, first, great to be here with you, Rana. And thank you all for being here and having us up here to kind of talk about this topic. And I think what we're trying to do is maybe talk for a handful of minutes and take questions as well, because I know it's pretty broad about what Paul and team asked us to spend time on. So I guess I'd start with, I think that the IPO markets are all about finding equilibrium, in terms of where sellers are willing to sell, buyers are willing to buy. And that's hard. It's actually rarely found. And I kind of laugh. Just over my 20 plus years of being in equity capital markets, a lot of it in the growth sectors, I get yelled at when stocks trade up too much by sellers. I get yelled at when stocks trade down on IPOs from buyers. And unfortunately, both happen depending on the type of cycle. I'd say given what's gone on over the course of the last couple of years, and it's amazing that we're kind of 2 years into the Fed, and other central banks, hiking rates. Finding that equilibrium has been exceptionally challenging. Now that to me is very natural because I think as all of you know, the cost of capital just went up significantly. When we were in negative real interest rates to where we are today. And I think the bar for investors is also materially higher investing in risky assets when they could put their money in cash, sitting here at 5% plus with zero risk. And so the IPO market naturally slowed down significantly across the globe, aside from a couple of regions in 2022, as we're trying to figure out that equilibrium in terms of, can we as investment bankers give confidence to companies to say, you can get a reasonable valuation with good shareholders at the time of the IPO, and then stocks are actually going to trade well, in the aftermarket for companies like yourselves to be able to, achieve your objectives, over time. And so what we really saw in 22, and this is why I'm kind of give a little bit of context, I actually do think things are better now and improving, is a dearth of IPOs, and the IPOs that actually happened, all happened out of corporate action in some sort. So it was more catalyst driven. So think of Porsche out of Germany, which was a spin out of Volkswagen. Think of Mobileye, Israeli company owned by Intel, which these are kind of done for value highlighting, value creation at the parent entity. And there were kind of different reasons versus just purely going public, and the deals were smaller as a percent of the company sold. And it really wasn't thought of as a financing event per se. It was done for, as I said, different rationale than getting public. Now, as we kind of moved into 23, to Rana, your question about what's changing or what's changed, I think the markets have clearly gotten somewhat better. They're not fully healed yet. And as investors across the globe have kind of gotten more comfortable and more confident that a soft landing is a higher probability than the view earlier this year that we're going to go into a recession, in the US on a global basis. You just saw incremental risk get added to the market, windows for issuance that were better, and I think it was just easier to see that equilibrium kind of come into balance because valuations were just rising in the secondary markets, and investors I think were willing to invest at higher levels that made sellers say, we actually have that confidence that we can get a better valuation, high quality shareholders in the aftermarket that would work. And so what we saw, so instead of just these corporate action driven IPOs or catalyst driven IPOs, we actually started seeing regular way IPOs. And I'm going to use the US markets. Not purposely being myopic on the US, but a consumer company like Kava, high growth, they did have profitability, or we were just talking about a DTC beauty brand like Oddity. These are just regular way companies that should be public companies that went public, and they went really well. We just saw 4 IPOs, across greater than $500 million between ARM, largest IPO of the year, Instacart, Klaviyo, Birkenstock out of Germany. And these deals all got reasonably good valuations. They got a great set of shareholders. Now, because the markets got a little bit tricky again, because now people are worried about higher rates for a longer period of time, the aftermarkets were more muted. But I think it felt good to us that the IPO discounts actually tightened over the course of the year. And there'll just naturally be cycles when they tighten up, there'll be cycles when they widen out. And I think that's good. But as I said, we're not fully out of the woods. The markets are broadly open for everyone. And I do think that's going to happen probably over the course of 24. Now, I think for this group, with a number of founders, some companies are going to be more mature than others. Let me just quickly touch on the market that's near and dear to my heart, given kind of I spent all my time, as I mentioned, I spent a lot of time in tech, media, telecom, is higher growth, emerging profitability. So this is the market that was the highest percentage of IPOs in any upcycle, 20 and 21 as an example. Yeah. Right? I think that market's going to likely take longer to develop because I think investors want to have more confidence in interest rates, begin to get cut and go down. Now, there's been some economic data points this week that are actually beginning to kind of highlight that, but I still don't think you're going to see rates getting cut until middle of 24 at earliest, unless something really bad happens to the macro economy. And so I think that's going to just take a little bit longer. But the question I get asked all the time is, well, the 10-year right now is sitting at about 4.5%. And is that conducive to IPOs, especially for growth companies like many of you have, for actually getting done and getting done in a reasonable way? And the one thing, just to add some historical context, outside of the post-global financial crisis, where rates were exceptionally low for the last 12 years or 11 years before this 2-year cycle, the 10-year is generally averaging 4.5%. And we've had plenty of times when great growth companies have very efficient access to the public markets. So that kind of excites me about, as we just find stability in rates, that we're going to be able to have a lot of access to, capital in the public markets, but it will take a period of time. Which does mean that some companies may need to work in the private markets to kind of continue to fund their balance sheets, fund their growth needs, as well. And I'd say if I kind of mention the equilibrium or lack thereof in the public markets for a period, I think the private market is an area that I'm actually surprised you actually haven't seen more activity occurring. And maybe that's because companies were able to raise a lot of money in 20 and 21. They were able to kind of increase their cash runways by cutting costs, which does make them better companies as well. But I do think we're going to see a lot more activity there, over the course of later this year and kind of into early next year. But I don't know what your thoughts are on that, Rana.
Yeah, I mean, this is an area that I spend most of my day on. And when we were prepping for this session, the way that you put it to me was when is the private market going to get real in the same way that the public market has already gotten real on what it means to be a great company? And that reality check hasn't worked its way through. You hit on one of the issues, which is really good companies raised at such high valuations in 2021 that then they and their boards took the decision to extend the runway, grow into that price, and the reality is by the time they go back to market, they will be in a net stronger valuation position because they have actually made their business a whole lot stronger than it was before. But the other reason why that reality check hasn't made it through is actually the investor base, my peers. So we had the experience earlier this year where we and a founding team agreed on a valuation. It happened to be a down round, even though the business is awesome. And then we got the call that said, we can't do this. I said, why? Well, our shareholders don't want to take the mark. And so the proposal is, will you guys accept a structured trade that has net the same payoff, but holds the mark? Look, it's no different to us. Frankly, actually, the payout on the upside is better in the structured trade, but this has bad hygiene. It misaligns incentives. It's not the way you want to be as founders. And they said, look, we totally get you, but our shareholders just won't do it. And then I got the phone call from the shareholder who was like, we just are not going to do it. And as long as that mindset of we don't want to let the marks trickle through the book still holds, then a lot of the traffic jam, frankly, in the private market is going to stay. And once people are ready to allow that equilibrium to reestablish in the private markets, then you'll start to see the flow that happens, at least in the primary markets. Secondary markets are a little bit different because we're still trading at a really big discount to the last round in the secondary market. And the reason is because there, you can actually potentially transact without the company and the current board saying yes or no.
Are you beginning to see more reality? You mentioned a deal earlier this year. Yeah. Are you beginning to see a little bit more as we kind of move later into the year in 24?
Absolutely. We're seeing a lot more reality check. Companies are now like coming into us and saying, look, we understand that the multiples are not where they were in 21, but let us tell you that we've 3x the business in the last year or whatever it is. So people are now coming to see us starting with the parameter of our expectation is not what it used to be. We are reasonable people. I think the only place where reality has not set in at all is AI. Everyone is now running around stickering themselves with AI, whether or not there is or there is not. My 2 cents is that in 3 years we won't be talking about AI in the same way that no one is shocked that people develop in the cloud. Everyone will use AI to make their business better. So there's no reality, and we have to be careful because if we follow the hype in an unmoderated way, then you end up both destroying the company because you actually have indigestion from the amount of capital, and then to make it worse, you have the bad return.
And what advice are you giving your companies right now in and around how to operate in this environment, with potential for slowdowns in global economies, how to finance themselves in this environment? How are you thinking about your marks?
We give a couple bits of advice. So, one advice is it might seem contradictory to the other, but if you're a market leader and you're in a really great position, keep going at whatever the efficiency frontier is for your unit economics. One of the risks, I think, of the last 2 years is the over-adjustment. So 2021, no one cared about unit economics. Nobody cared about quality of earnings. Very few did. I still did. Just grow, right? The swing is now, gosh, hunker down, don't grow as fast, conserve your capital, but that can be the wrong answer for someone who's a market leader. So we're a little bit nuanced there. For people who are not in that bucket, it is, again, that efficiency frontier analogy. What is the efficiency frontier for your business of unit economics and quality of earnings? And let's find that equilibrium. Because without it, then you will not be viewed as well the next time you go raise. And there's a lot more scrutiny put on non-profitable companies earlier on in the cycle, basically, which was not the case in 20 and 21. I mean, with respect to marks, I grew up here, so I'm a fair market zealot, basically. And so that zeal actually permeates through Balderton because my previous partner also ran capital markets at Goldman too. So that's it's a way for us. And so we never got overexcited in 21, and therefore we haven't had to get overexcited in the other direction in 23.
Good. So given part of this is private, part of this, what advice, when you think about some of your companies who want to be public companies, what advice are you giving them as they think about preparing to be public and then life after going public?
My first advice is the road is actually really long. People think that you wake up and I'm going to be a public company and I'm going to hire a banker and that's the end of it. Well, it's not the case. There's really boring but important things that happen that all too well. Are you compliant in the US for Sarbanes-Oxley? Can you actually report your financials with financial controls on the same day that you have your earnings, right? So many companies in 20 and 21, they went public and they couldn't do their announcement and their 8K on the same day. That's a controls problem. You need to fix that. You have to have a board that is ready to be a public board, a CEO and a CFO that can withstand the pressure from the analysts, right? And then you need a cap table that's really strong. So we spent a lot of time talking to our portfolio about the fact that you don't want a cap table that runs away when the lockup lifts. So what can we do before the IPO to get the cap table IPO ready so that people will stay, the shareholders stay with you once you are public? And that is, the whole thing, frankly, as a package, is a job that starts 2 years before you really make the decision to go, from my point of view.
Well, I mean, I think that's a great point. Maybe I'll just use, in wrapping into one of your other points made earlier, we led, I think, the largest private placement ever for Stripe in March. And they actually they wanted to do pure common. They didn't want any structure. They already were going to take a pretty big haircut on their valuation. But as we kind of went through the process, knowing that there's not going to be a lot more rounds before they go public, when they thought about the quality of investors, they actually took the valuation down further, even though they didn't have to get the round done, to bring in some of these very durable, long-term, investors. So I think the point you're making is very, very solid one.
Awesome. Should we let the audience ask a question or two?
That'd be great.
Excellent. Is there anyone who'd like to share a question with us? You press the button on the mic if you want to do it. There's like a button in front of you.
How do you manage the disconnect between the last private round and now the IPO, 20%, 30% down?
I think there's two ways to manage this. The first one is the board governance point that I made, which is when you're that mature, you should start to have a board that isn't 100% your shareholder base. And so good governance lets you make the right choices for the company. The second one is to have, ideally, as little structure as possible from my perspective, so that there's really good alignment among your shareholder base.
From a market, I'm going to say from a market perspective, public market investors don't care. Right? They think that the right thing to do is do what's right for the IPO and kind of starting life off as a public company, and things are going to work out, over time, and then then that hurdle will get cleared, hopefully in a very short period of time. And so we've had this dialogue. It's a great question with a lot of companies who kind of fear that starting either a range or pricing below what the last round was just causes a lot of anxiety, whether it be at the shareholder level, a lot more at the employee level, and how to manage that. And I think that it really comes down to very strong leadership to say that we're confident that going public is the right thing to do. We're confident in the way that we're going to be able to execute. No one controls the market, but control what you can, react to what you can't. And that over time, it's going to be the right thing to be able, whether we get liquidity, have an acquisition currency, or branding, or whatever the rationale is. But this is something we've dealt with in a lot of cycles around this.
We'll take one more. Go ahead.
Does that work? Right.
Yeah.
So as the SEC is kind of continuing to add more and more restrictions on companies, whether it's on the selling stock and stuff like that, do you think that when the interest rate goes down, we'll go back to a world where companies, where the private markets are the real public markets, like that was the case a few years ago?
So I think when people feel like rates are going down, I think is when you're going to see secondary valuations lift and the markets be just much more receptive to the broadest array of companies. And right now, every company going public, unless it's going to be an AI company, is basically profitable. As the asset class gets a little more in favor, I said the IPO asset class, you're going to start seeing a quarter or two to profitability, and then it will go to a year or 2 years of profitability. Do I expect kind of the environment we had in 20 and 21 again? No. But if you ask me, we had a great market in 06, 07, and then the financial crisis happened, and no one thought we were going to go back to what happened in 06, 07, then 13, 14 happened, right? And you didn't expect valuation to get to where they were in 13 and 14, and then we just had the last handful of years. And so this world cycles, and so I have no doubt that we're going to get to a period where investors really want to lean into high quality growth. But in the interim, you're just going to see the questions that the portfolio managers ask the analysts just get harder, and that happens on the private investing, it happens on public investing. But there's going to be a point where the investors start seeing these deals start working very well, the companies execute very well, and they're just going to be missing their benchmarks. And so they get a little bit more lenient, and at some points irresponsible in terms of the way that they're kind of just investing in these companies and buying in the market. And so I think it's those investors, just like Rana kind of talked about Balderton, as a firm, it's those that show a little bit more level-headedness over the course of a cycle, I think that do well. And that's actually one of the signals that I personally look at when we kind of assess the quality of our books of demand and who we're allocating to. We just don't want all the momentum-driven investors. We want some of the ones that are very level over the course of cycles. That kind of sends a real signal to us.
With that, I'll let you have the last word. Thank you for joining us in our dialogue together.
Really appreciate it.